today I'm here to talk about the state of risk mostly in the equity markets, actually. I will touch on a few other markets, but the major focus is going to be the equity markets, and that's really where a lot of the interest and the maybe concerns have been recently. First, though, I just want to introduce everybody to Axioma. Some of you may not know who we are. We are in the business of providing risk management, portfolio construction, and performance attribution solutions to asset owners and asset managers. So we have a series of risk models that we use to cover 14 different markets. We also have a very high-end optimization tool, as well as performance analytic tools. We've kind of grown up. We've been around since 1998, and we've basically grown up in the equity business. But about a little over a year ago, we released our multi-asset class product, and so are making more and more headway in the multi-asset class space, where I think more and more money seems to be flowing. So just a little bit of review of what we were looking at in the third quarter in terms of market risk. And by the way, when I'm talking about risk, the focus is really on two major components of risk: volatility, and whether that's volatility of individual stocks, volatility of certain factors, volatility of industries, currencies, individual country equity markets. One side of the equation is volatility. The other side is correlation. So you can have a series of very volatile markets, but if they're all moving, or if none of them are moving together, so you have high volatility but low correlation, you still have a relatively low risk environment. So when I talk about risk, I'm talking about this kind of conglomeration of volatility and correlation that we at Axioma is the major output of our risk models. So our risk models are intended to basically forecast risk, forecast future volatility over various time horizons. So we have models that look over the next 1 to 3 months, and we have models that look over the next 3 to 6 months. We have fundamental factor models where we're looking at a set of predefined factors, such as size and leverage and liquidity and all different things that may drive overall market volatility. And then we also look in our fundamental models at industries and countries and so on. So we have fundamental models, and then we also have statistical models where we essentially let the data speak. And the reason I'm kind of going through all of this is that all of those different kinds of models, in one way or another, are going to figure in my talk here today. So first of all, basically for the first 3 quarters, basically from roughly April through the end of September, we were in a period of steadily falling risk. So equity risk was going down, bond risk was going down, currency risk was going down, CDS spreads were falling. So all the measures of financial risk that we look at were basically all coming down. Even if you look at some of the areas that you might have thought would be extremely risky, such as Ukraine, Russia, some of the real geopolitical hotspots, we saw risk coming down. The one exception over this period was Europe, where we were starting to see risk creep up. All of these various components of risk fell. So it wasn't just one thing that was driving risk down. Risk in individual countries was coming down. Risk in individual currencies relative to the US dollar was coming down. Overall market risk was coming down. Correlations had come way down. So, we generally look at a high correlation environment as one in which there seems to be some grand theme that is driving stock prices. So if you think of, perhaps the financial crisis in 2008, correlations were very high because there was, this concern about global fallout driving stocks around the world. When correlations are low, we view that as suggesting that investors are really looking more to individual fundamental characteristics of companies as what's going to drive their differences in stock prices. And that effectively is a somewhat healthier market, particularly for active managers. We earlier this year had seen emerging market risk increasing relative to developed market risk. Trading volume was way down. And so around about August, we did a little study just looking at, we have the longest history of data for our US equity models. So so our data goes back to 1982, and we just wanted to take a look at, we were in a period of very low risk. I think by August, we had probably reached an all-time low level of market risk in the US. And so we just wanted to look at kind of what were the characteristics of a low-risk market. And I'm going to talk about this in a minute, but I think the important point there was that in advance of almost all of the market peaks that we've seen since 1982, risk, and as we measure it, and as I'm going to talk about it, started to rise and rose substantially well before the market peaked out. There's always a lot of talk about, is the next correction right around the corner? But certainly going back to August, we didn't see a lot of risk, a huge amount of risk that there was going to be a big correction. I write a series of quarterly investment reports. So I cover 8 different regions and go into a lot of depth about what's going on in the risk in the equity markets in each of those regions. So it's a quarterly report. I start writing it right after the end of the quarter. And sure enough, I'm writing about how calm the market environment is as, everything is falling apart around me. So it was like one of those dilemmas, how do you, so I ended up just kind of talking about the environment that was, and then go around doing these presentations to focus more on the environment that is. So right after the end of the quarter, risk jumped fairly substantially, let's say from, 9% to 13% for the Russell 1000. It still remained low relative to history. It only seemed high in contrast to what we had seen over the summer. And since then, risk has actually settled down. Again, not back to all-time lows, but it certainly has calmed down quite a bit. The components of risk that I was discussing, country risk, currency risk, market risk, all increased. And now while market risk has come down, we've actually seen currency and country risk remain somewhat elevated. Correlations increased and then came back down. Emerging market risk, perhaps not surprisingly in kind of a heightened risk, heightened concern environment, emerging market risk started to increase relative to developed market risk. But most recently, we're actually looking at risk for the FTSE Emerging Market Index is actually lower than risk for the FTSE Developed Market Index. So several of the slides in this presentation are going to focus on that. We as I mentioned, have seen an increase in country risk quarter to date and year to date. Currency risk, I'll talk about that a little bit. We also finally saw trading volume start to pick up. But even that has settled back down. But the bottom line is we still don't see any strong evidence that we're being set up for a big correction right now. So this is probably hard to see in the back. Let me just tell you what we're looking at here. So this is a chart of predicted risk from our short horizon model. So I mentioned that we have a model that looks at kind of a 1 to 3 month horizon. And so starting on the left, the green bar is what the model was looking for a year ago. The red bar is the end of last year. The purple bar is as of the end of June. And then the blue bar is more recently, as of November 10th. What we've got listed here is a series of benchmarks, starting with North American benchmarks, European, Asian, and then global benchmarks. And I think probably the thing that stands out on this chart, looking at risk forecasts at specific points in time, is that in most cases, recent risk is higher than it was a year ago, but not everywhere. That's not true in Asia. It's true in the US, in Europe, maybe particularly in Europe. So, okay, so you see this and you say, well, how did we get there? So here, one of the features of the risk models that we provide is that they are recalibrated daily. So we're providing daily risk forecasts on a whole bunch of different markets. And so here what I've done is for the year-to-date period, looked at the daily forecasts for a series of markets. So the upper left-hand side here, we've got the red line is the Russell 2000, the blue line is the Russell 1000, and then I've kind of put North America all together, so the TSX composite here. And you can see that right in the middle of September, we saw this risk climb, and then for the US, it's pretty much flattened out. It hasn't come back down substantially, but it has flattened out. Europe, we started to see the increase a little bit earlier. So this is the FTSE Developed Europe Index. But it also, at least through November 10th, which is when these charts go through, hadn't started to decline yet. I think it's fallen off a little bit in the last few days. In Asia, you really didn't see the same kind of increase. So we've got, I'm going to come back to this line in a minute. The green line is China's CSI 300. The kind of turquoise line is Asia ex-Japan. And the purple line is Australia's ASX 200. So there, you didn't really see a large increase, and just not much has happened there. But what's been most interesting, and maybe not that surprisingly, volatility in Japan, which had been on a steady and sharp decline. So if you look back to April, predicted volatility for the Japanese market was 23%. It came down to about 13%. And then just over the last few weeks has shot back up to about 23%. Clearly, overall volatility in the Japanese market is looking very different. I don't know if anybody is investing in Japan, but I would imagine for an active manager, it's been a particularly challenging time, or if you're doing asset allocation to Japan. And then finally, on the bottom here, just developed versus emerging markets. And so, fairly similar. The darker line is the emerging markets. The green line is global developed markets. So, kind of this roller coaster pattern of risk in many markets. For US investors, the small cap versus large cap picture has been very interesting. So here what we've got, this is the ratio of Russell 2000 risk to Russell 1000 risk. So as it's going up, small cap stocks are becoming riskier. As it's coming down, large cap stocks are becoming riskier relative to their size counterparts. The blue line is kind of a medium horizon forecast, so looking out a little bit farther. The green line is our short horizon forecast. What's been really interesting is, long about the end of July, in August, there was so much concern about small cap stocks, and small cap stocks had, large cap stocks were up a lot this year. By that point, small cap stocks were, flat to down. They were also much more volatile. So at this point, so at the peak here, the small cap stocks were about 60% more volatile than large cap stocks. Since that point, we've seen that relative volatility come way down to the small cap stocks are still a little more volatile than large cap stocks, but not substantially. Again, quite a challenge for anyone actively managing portfolios. Yes?
I'm confused. Is that your volatility forecast or realized volatility?
This is our volatility forecast, which is a function of realized. It's kind of a smoothed function of realized volatility. What most of our clients use these models for are two things. Probably first and foremost is to manage active risk in their portfolios. So when you see benchmark risk increasing substantially, active risk is likely increasing, but there may be different drivers because it depends on what your active exposures are. So most of our clients use these models just as a way to focus on maintaining a level of active risk. But then they may also use it as a way of determining how much active risk they want to take. If overall market volatility is very high, then they may want to dial down the active risk in their portfolios. And then maybe a third way that people use this is, if you are out discussing your portfolios with your clients, a lot of people like to kind of just have a good understanding of what is the broad risk environment that they've been investing in, and kind of what are the drivers of risk. So that third part is, probably what I spend the majority of my time looking at. So now another, kind of bowl of spaghetti up here, but let me tell you what we're looking at. On the left-hand side, we've got our short horizon model. So this is looking at our predicted volatility for various components over the next 1 to 2 months. The black line is currency risk, so aggregate currency risk for developed markets. The blue line is country, so aggregate country risk for developed markets. And then the purple line is market risk. So you can see all of these components of risk increased fairly sharply. Market risk has turned back down a little bit, but the other two components have not really turned back yet. So currency risk and country risk is still elevated, certainly till relative to where it was a couple of months ago. And just about where it was at the beginning of the year. Then this looks at the same thing from our medium horizon model. So as I said, our risk forecasts are a smoothed function of realized volatility. So if we're talking about medium horizon or a 3 to 6 month kind of forecast, we've got a longer period of smoothing. So it's going to tend to smooth out the results a little bit, but you can see even so, risk has gone up, but for example, medium horizon currency risk still isn't even up to where it was at the beginning of the year. So developed markets, we have seen all the major components of risk. So then we dig down a little deeper. Well, which currencies, which countries? Here, what we're looking at is the blue bars are year-to-date numbers. So actually, year-to-date, most currencies relative to the US dollar are looking less volatile. But quarter to date, all of the developed market currencies have seen a fairly sharp increase in their volatility. So this is the yen. It's probably hard to read these things. So particularly the yen, where volatility is up about 45%. The euro, where volatility is up almost 40%. And then it goes down to the Swedish krona, where volatility is up about 15%. So currency volatility has increased by quite a bit. To some extent, it's been a little offset by falling correlations between the currencies. But again, if you're managing a multi-country portfolio, the characteristics of your portfolio have probably changed quite a bit. And again, I recognize this is hard to read. This is all the countries, all the developed market countries. And again, the blue is year to date, the red is quarter to date. And kind of what stands out here is a big, almost about a 70% increase in volatility in Portugal this year, but a similar increase in Canada, which is, I was up in Canada last week. I think some of the investors there were maybe a little surprised by. Now, the difference between Portugal and Canada is that Canada came from a very low base. Canada at the beginning of the year was probably one of the lowest risk of all of the markets that we look at. So a 60% increase is from very low to only somewhat less low, or somewhat less high, as opposed to Portugal, which was kind of the opposite end of the spectrum, started out high and has really skyrocketed. I mentioned we'd look a little bit, so we've been focused on equity market risk and currency market. Here's just a little, I'm going to diverge a little bit or digress a little bit. This is looking at bond yields, at sovereign, 5-year sovereign bond yields for a set of developed market countries. And what's been kind of interesting here is you saw, particularly in Portugal, so this purple is Portugal, you saw an increase in yield. But in most other countries, the bond market has not really followed the equity market in terms of increasing volatility. And in fact, in the UK and the US here, was actually coming down a little bit. So lower bond volatility at the same time as we were seeing higher equity volatility. Again, implications if you're managing a multi-asset class portfolio. We also look at CDS markets, so kind of the probability of default. Now this looks a little more similar to the equity markets. And I apologize, I should have kept the colors the same for the same country. But so here you can see that Portugal, about the same time the equity market was swooning, we saw increase in CDS spreads in really the Euro periphery countries. So Portugal, this is Italy, and this is Spain. Not much happened in Ireland or France. So close ties between CDS and equity markets in some markets, but not all markets. Now I'm going to just turn to the emerging markets where the picture is very similar. So increase in currency risk, although not as dramatic as what we saw in developed markets, largely because the volatility in emerging market currencies already was substantially higher. So increase in currency, a particular increase in market risk, and some increase in country risk. Again, short horizon, very little change in medium horizon country risk, actually. So then we dig down a little bit more into the individual currencies. This is year-to-date change in currency volatility for the ruble, which again, maybe not surprisingly, has seen a big increase. Not only is there some, what's going on with Ukraine, but you've got lower oil prices. Most recently, you have the decision to free float the currency. So, a very large increase in currency volatility. So about 120% for the ruble. Interestingly, the Ukrainian currency, which I haven't included on here because it would dwarf the rest of the graph, the Ukrainian currency risk or volatility is up about 800%. So clearly a bigger issue for Ukraine, but still, quite a substantial increase in volatility for the ruble. And then, the picture is much more mixed for emerging markets. So these are individual countries where you can see, so this is Russia. So again, the year-to-date change in country volatility. So a big increase in Russia, big increase in Brazil. This is Oman, Malaysia. But quarter to date, we've seen, some countries where risk has come down. China, India, Poland on the end here. So, again, kind of a mixed picture. It definitely is more of a mixed bag in emerging markets than in developed markets. Same thing here, just looking at sovereign yields, not much of a change, certainly around the time of the equity markets, with the exception of Russia. And then CDS spreads, again, the same thing, an increase in spreads across different countries, but they've settled back down as well. This is a chart that I find very interesting. So let me tell you what we're looking at here. The blue bubbles are developed markets. The green bubbles are emerging markets. On the x-axis is our short horizon risk forecast. And on the y-axis is the return over the prior 6 months. So going back about a year, you were looking, so these green, and by the way, the size of the bubble is the relative size of the market. So going back about a year, you can see that the emerging markets, by and large, were higher on the risk scale and somewhat lower on the return scale relative to developed markets. So if you think of this as kind of the risk-return trade-off between these markets, developed markets were really looking a lot better. So lower risk, higher return than the emerging markets. If you fast forward to last week, so we're looking at the same thing here, but the emerging markets have really kind of moved from risky and negative to less risky and positive. And right about, now this is India, by the way, so very high return, kind of relatively low risk, certainly no more risky than many of the emerging markets, of the developed markets that we're looking here. But it's really been kind of a really big change in the nature of the risk-return trade-off for emerging versus developed markets. So, and I think particularly on the risk side of things, where, if you think back a year or 18 months ago, the Fed had initially announced its plan to taper. Emerging markets kind of went haywire. And then that settled down, and they really have actually done quite well since then. If this is a chart that you're interested in, by the way, this is something that we publish daily on our website. And on the website, we actually put the individual countries. So it gives you a little more information. I just thought that for a presentation like this, that would get a little messy. But it is something that we track, and you could track closely every day. Well, nobody looks at it every day, but the day you look at it, you'll know it's the most recent data. And then just another way of looking at this picture. So this is just the ratio of the predicted risk of the FTSE emerging index to the FTSE developed index. And you can see again, so, kind of mid-year, emerging markets were maybe 30% riskier than developed markets, whereas now the risk forecasts for emerging markets are below that for developed markets. It's also interesting just to see the longer term, how this, if you look at kind of a trend, emerging markets in general have been trending down in terms of their risk relative to developed markets. So again, if you're making this emerging versus developed decision, you may be looking at lower volatility in emerging markets. I mentioned earlier the little study that we had done that looked at market risk and how that related to market peaks. So basically what we've done here is, this is for the US market. We created a cap-weighted index of the 500 largest stocks and then calculated the risk from our short horizon model. And so this plot is a plot of that risk. So first of all, you can see here at the end, although risk has come up, it's still quite low relative to where it's been historically. So we're really looking at a kind of very low volatility market still. But you can also see, so this is the market peak in September of 1987. At that point, now of course volatility went up after that, but from about April of 86, no, I'm sorry, it's about April of 86 through September of 87, risk had fairly steadily been increasing, and it was up about 10 percentage points. You see something similar in advance, although a little shorter, in advance of the peak in July 1990. You see the same thing before October 97. The 2001 peak, you don't really see the same kind of thing. And the 2001 market peak was really kind of related to the internet bubble, which maybe makes it a little bit different than some of these other market peaks. And then similarly, before the peak, market actually peaked in October of 2007, and we see a similar kind of 10 percentage point increase in our risk forecast. So, right now we haven't, risk is up a little bit, but nowhere near that kind of increase that we've seen before prior market peaks. This makes us, somewhat comfortable to say that maybe on the near term, there's not a big correction coming. This is not taking into account any kind of valuation data or economic data or anything, just looking at risk data. So what volatility may be telling us about concerns in the market. So from a volatility perspective, we're not overly worried about an upcoming major correction. Doesn't mean, clearly we may see some smaller corrections. And then here, this is just looking at different risk regimes and what the subsequent return over the next 3 months is. So when risk has been low, returns have been the best. That's basically the takeaway from here. If we move into kind of a moderate risk kind of setting, that actually is the worst scenario for 3-month returns, 3-month forward returns. And then VIX, we all talk about VIX, we all look at VIX. I thought it was kind of interesting just to include a little bit longer term perspective. Sure enough, as concerns started to pick up right after the end of September, VIX popped up. So what we've got here, it's not just VIX. We've got the blue line is VIX, and the red line is the VSTOXX index, which is the same kind of option implied volatility for the European markets. So bottom line here, this is the long-term average for the VIX, and then the VSTOXX tends to be slightly higher in general. So that's the long-term average for the VSTOXX index. So you can see, we had a little pop above average, but even the VIX has come down. I guess it's up a little bit today, but we're still looking at relatively low levels of risk from the perspective of the VIX. Now, one of the things that we look at is whether is it volatility or correlation that's driving the change in risk. And I'm not going to go through that, but so what we're looking at here is, I mentioned that we use fundamental factor models. This is looking at the fourth quarter, so just since the end of September, really whether it's volatility or correlations of the factors in our factor model that have driven the increase in risk. And in most cases, it is, you can see that volatility has been the major driver of risk. So as opposed to correlations across factors. This is country or regional indices, and this is looking at the global developed market and FTSE emerging indices as well. So, largely this has been a volatility story, not a correlation story. But because we are interested in the impact of individual stock correlations, that's what we read about, we talk about, what's often in the news. So we also dig a little deeper and look at the impact of individual stock volatilities and individual stock correlations. So here we're talking about factors. Here we're talking about individual stocks. And what's kind of interesting here is that while stock volatility, so the overall risk forecast, individual stock volatility has been a major driver of the increase in risk. Higher correlations have also become, have also had a major impact. It's particularly true if you look at Asia ex-Japan, which is this purple bar. Correlation is about equivalent to volatility in terms of driving the change in risk. This is the Russell 1000, this red bar on the left. So correlation among US stocks has also been particularly important. Well, why is this important? Well, if you're managing a portfolio, if you've got active risk, those correlations of individual stocks are going to have an impact on the active risk in your portfolio. So it's just another way, we like to talk about what we're doing in all these presentations is peeling the onion. So you start with what's the risk for the benchmark, and then we peel off the layers, looking at volatility and correlation. Then we look at, among those things, countries and currencies and markets and industries and style factors and so on. And this is kind of another layer down, looking at a full dense covariance matrix and what implications that has, and particularly the impact of stock correlation. So I just want to point that out. So these correlations, when I talk about stock correlations here, we're talking about what's coming out of our risk model. So it's really kind of a predicted correlation. This is realized correlations. And so, there's been, I guess, some concern. Correlations have gone up. What are the implications? What are the longer term implications? Does it mean that there's some big unifying theme driving stock prices? Or does it mean that, or does it not mean that? And so we look at the realized correlations. So this is the median correlation within this universe. For example, the red line is the Russell 2000. So the median correlation of daily returns over the past 60 days. And so you can see that correlations have gone up. The Russell 1000, the Russell 2000, Europe, not so much in Asia, but, and I'm going to get to this one in a minute. They've gone up, but really they're nowhere near the level that we were seeing during the global financial crisis or the European debt crisis. So the market seems to be indicating that maybe there's a little more kind of economic concern, but it's not an overwhelming concern that's just making everybody dump every stock. There's still some discrimination between the better stocks and the worse stocks. Now Japan looks very different. So this green line is Japan, and actually correlations among Japanese stocks are close to all, or at least high level since 2000. Clearly Japan has its own set of issues. It's the economic drivers, the political system, and so on, and that's really reflected in what's going on in correlations in Japan as well. So when I talk about dispersion, what I mean is the cross-sectional volatility of stocks. So the idea is basically, or the cross-sectional standard deviation across stocks. If dispersion is high, it means the best performing stocks have done substantially better than the worst performing stocks. If dispersion is low, it means there's not that much differentiation between stocks. We kind of view this as being a measure of the opportunity set for active investment. So if you're a stock picker and you're really good, but dispersion is very low, yeah, you'll outperform, but you're probably not going to outperform by that much because even the best stocks aren't doing that much better than the worst stocks. If dispersion is high, on the other hand, there's a much bigger reward to being right and also a much bigger penalty to being wrong. But so dispersion is something that since about 2010 has been actually quite low. A little bit difficult to distinguish the winners from the losers. But interestingly, just over the last, this data goes through the end of October, actually. So just, because we only do this monthly. In October, the opportunity set for active managers actually increased by quite a bit. Well, dispersion is very closely related to all the volatility numbers that I was talking about before. So when stocks in general are more volatile, dispersion is also going to be higher. So to the extent that volatility forecasts remain pretty low, it suggests that dispersion, this was, I said this ended in October, and so it suggests that that number's probably going to come down again as dispersion comes down, as volatility has come down. So volume had increased by quite a bit. So this is trading volume in various markets, but volume has dipped back down. Volume does seem to be very closely related to volatility, and although I don't think I can prove this, my suspicion is that the more volatile markets, the more high-frequency traders are coming in to take advantage of that. And when markets are very calm, there's not really a lot of advantage to them, so they're out of the market, and volume is down. So we see US, Europe, same is not true in Japan, so big increase in volume in Japan. Asia hasn't, seen much change at all. And then but if you look broadly at developed and emerging markets, volume is down. I mentioned we have models that look at risk from a statistical point of view and models that look at risk from a fundamental point of view. So the statistical model basically does a principal components analysis. It says there's some factor that, that explains 20% of the risk in the market. And then you X that out, and then the next factor explains, another 10% of the risk in the market, and so on. It doesn't say what those factors are. It's just looking at what stocks have done and using that as a definition for risk. The disadvantage to using a statistical model is that you don't know what those factors are. You can't say, well, I know that I have a big size exposure and size risk is increasing. But the advantage is that it can pick up on things that a standard fundamental model may not see. So if you have a European debt crisis looming or on the surface there, the fundamental models aren't necessarily going to pick that up, but the statistical model might. So what we look at is the difference between the statistical and the fundamental forecast to tell us whether there's something bubbling under the surface, that whether there's some risk that's not kind of a predefined risk factor that's bubbling under the surface. So what we're looking at here is the difference between the statistical and the fundamental models. And this graph is kind of a mess, but what we really want to see, to not be worried about a big risk surprise, is lines being under the 0 point. And in fact, in most markets, we're seeing the statistical forecast below the fundamental forecast. The one exception is the Russell 2000, but even that, the difference is very small. So the point, the major point here is that based on what our models tell us, we don't see anything bubbling under the surface. That's an unknown risk out there. Clearly risks can change and can change, dramatically and quickly. But for right now, there doesn't seem to be something that we haven't recognized in our standard risk models. So that's basically it. I mentioned, those bubble charts that you could get on our website, www.axioma.com. We produce what we call a daily risk monitor. So a lot of this data is produced daily for 10 different markets, including, kind of broad emerging and global developed markets. You don't have to be a client. You can just go onto our website and look at these reports. We also send out a weekly email with a few observations about what we're seeing in the world of risk, and you can just sign up, put in your email, and you'll get this email pushed to you once a week. No obligation, just if you're interested in what's happening in risk, you can go sign up for that. And then, so just quick summary, risk is closer to historical lows than it is to historical highs. Volatility has been up, asset correlations have been up and have had a larger than expected impact on risk. Country and currency risk was up as well, but unlike market risk, it hasn't really settled back down. Emerging versus developed markets, we're looking at potentially a better risk-return trade-off for emerging markets. We haven't seen a lot of evidence that equity market risk has spilled over to bond markets or to CDS markets, at least not yet. Periods of low risk, first of all, have lasted longer than this current period of low risk. And we've seen risks start to rise well in advance of market peaks, so we haven't seen that yet. Again, the last thing that I talked about, these risk spreads, they seem to suggest that there's nothing bubbling under the surface that might lead to a sudden increase in risk. So finally, just to summarize, we remain cautiously optimistic that we are not about to see a huge correction and enter a period of higher risk. I think I'm 2 minutes over, sorry.